All right, let's discuss Fibonacci, how to use Fibonacci and what we use Fibonacci for. So basically Fibonacci, we use it to measure a retracement. So we're looking for an area where we think price might come back to, right? So the Fibonacci measures that area and then you can set your limits there, or you can watch price to reach that area and then you take action from there. All right. So for an example, let's look where we have a trend. Because remember, we're looking for price to give us an impulse, and then in that impulse, we're trying to figure out where price might retrace to, and then we can attack from there. All right, so from here, we're saying, let's say we have this trend, right? So let's mark our high and our low. All right, let's mark our high and then our low price is made is this one. And then if we look at the action that has happened here at the bottom, it looks like price is trying to reject. All right, so if price might be trying to reject, let's go on the 4-hour time frame. On the 4-hour time frame, we will then now take our Fibonacci, and then you put the 0 where price has made a high, and then you drag it up. All right, and you put the 100 at the high. All right, so this is the area that price is giving us as an impulse. We have our high and we have our low. All right, so you put the 0 where price is trying to reject, and you put the 100 where price is created the high or the low. All right, and then in that area you're trying to find 61%, which is this area, as you can say, 618%. Right, so we're saying this is one of the areas that price might potentially retrace to give us a correction, right? And then possibly push lower if price is going to push lower. All right, so price normally retraces to 61%. However, 78.6% also is a very good area. All right, so price could potentially rise. Price could potentially rise to 61%, right? And then from 61%, reject a bit. So we're saying price could go to 61%, reject a bit, come back for a retrace, and then finally 78%. And at that 78%, that's when we can see price creating some sort of a rejection or a reversal pattern that can push price lower back to our low and possibly retest, continue with the trend. All right, so this is exactly what we imagine price doing. But however, this whole move will not take just a week or so. It can take a couple of weeks, sometimes if you're lucky a couple of days, if there's enough volume in the markets. All right, so I would say the first area to look out for if you're looking for retracement is 61%, and then if price can reach 78%, that's even much better. All right, but however, if you see price going above these areas, right, then that's telling you that price is reversing. All right, so the trend will be changing. All right, so let's do it again one more time. So we're saying a Fibonacci, we use it to find areas that we think price might retrace to, right? So once it retraces to that area, it rejects that area, giving us our next impulse. Because remember, price gives us one impulse, correction, and then another impulse. All right, so if you want to catch the big trade, right, instead of catching a correction, you want to catch the next impulse. So the first impulse is sort of a signal. The correction is price retracing to a better price that you can enter it to push price into the correct trend, the correct direction, and then you catch that impulse, right? Then you can catch way much more than what you would make if you were using a correction only, right? So we're saying you highlight your high and your low, which we have. This is our high that was made, and then this is the low that price is at, that price is made, and it looks like it's rejecting, right? we had our first low, price came back to retest, and then with another retest and price rejected again, right? So we then take our Fibonacci, right? And then you put the 0 to the low and the 100% to the high, right? So since this is a downtrend, that means if it is an uptrend, you put the 0 on the high and the 100% on the low, all right? Because remember, it's just the opposite. And then you highlight where your 60% is and where your 70 and where your 78% is. All right, so our 100 on the high, and then our 0 at our low, and then we highlight our 61.8%. And if you look to your left, it looks right? You can see there's even a zone there. And then we highlight our 78, right? We remove our Fibonacci because we don't need it anymore, right? Since we have highlighted our areas, we remove the Fibonacci. We remove the Fibonacci, and then we readjust our zones because you don't want your candlesticks to be cutting through candlesticks, right? I mean, your lines cutting through candlesticks. And there you go. So now you have your potential areas for price to reject to. So if you see price breaking out at that high, at this high, right? So what you'd want to see is price breaking out at this high. We have our high. And then what we want to see is we want to see price breaking out, giving us some sort of a retest, and then an impulse to our 61%. And then from here, you can expect price to reject to give you that next impulse. If price doesn't give you that next impulse and then it comes back to retest, right, and then it rejects, then you can expect price to get to our 78%, and then you can watch out for a rejection. And if it does reject, you want to see price going below, right, below, back into the low, back into the into our last range, into our last consideration, right? This is our last consolidation, right here. That's where we want price to come back into, and then from there we want price to drop out, break out, and then we can see price continuing continuing with the trend. That's what you'd want to see. That's if price is going to do that. Remember, this is just to show you how you use a Fibonacci. All right. You know what to do if you have any questions.